You ready? All right, I'd like to call our Finance and Audit meeting to order at 8:30 and 34 seconds. Dan pointed out that we have seconds now on our clock, so. Oh boy. Yep, so we're 34 seconds late, I apologize. We have everyone here except for, oh, Terry's here, so we're only missing Eric and Brian this morning. We have minutes for approval. I'll entertain a motion to approve the minutes. Larry moves. John seconds. Any questions or concerns? If not, all those in favor say aye. Aye. Any opposed? Okay, motion carries. Public comment? It can be staff comment too, as far as that goes.
Here, I'll do this. I'll fill in for Scott.
Huh?
I'll fill in for Scott.
What's that?
Last call. No, it's not as much information.
It's all good. All right, member comments. Any members have comments? All right, we're on the presentations then. Our fiscal 24 audit. Good morning.
Good morning. Nice to see all of you.
How are you today?
Doing well, thank you.
How is the cheese hand land?
Thanks for having us.
You didn't even answer that.
Still cheese.
Still cheesy. All right, there you go.
That's why I brought Lead. I handle all those pump
Okay.
There you go. So it's nice to see all of you again. I'm John Rader. I think I'm familiar to all of you. And this is Leah Gaffney. And Leah joined us virtually last year. I think you were fighting off an illness, so yeah, it's nice that she could join me. She's been a big part of the audit for the last several years, managing it with the rest of our team, including Taylor Bogley, who was not with us this morning, but she's been a big part of it too. We're going to spend most of our time, probably 5 to 10 minutes, going through these financial results. And if you have questions, as always, let us know. That's one of the reasons we're here. I'm going to turn over to Lita to talk about those. But before I do, just to kind of talk about where we're at, we actually just issued in final last week, right before, or to give a couple days at least, for the county to submit their annual comprehensive financial report, their ACFR, to the GFOA for what will hopefully be the 27th consecutive year of the award that they give out for excellence in financial reporting. So it's a high bar. The county has, kept that going. Has a very nice looking report, and so hopefully you'll get that award once again. We're not going to walk through those statements because it's a large document. We audit a lot of them. It is one of the bigger ones that we audit. But if you are going to spend some time on it, take a look at the MD&A up front. It's like an executive summary. It gives you not just where the numbers landed, like we're talking about, but Carrie and Doty do a great job of explaining why things changed for each one of the funds. Just in looking at our notes yesterday, I went back to it myself, so it is very useful. It won't take you long to get through that MD&A. I also think the transmittal letter right up front, it talks about non-financial information, economic things going on in the county. It's written by, in large part, I believe, by administration here, so take a look at that. And I actually like the back part of it, the statistical section, because it gives you 10 years of data, financial data, like where your fund balance is, where's your debt capacity, all those different kinds of things, FTEs.
We don't care about debt capacity.
Okay, it's NA now, right?
Yeah, right.
Which is a good thing. But if you're going to focus any time looking at the financials or go back to it once in a while, those are areas I would draw your attention to. One more thing I'll mention, just overall, how did the audit go this year? It did go really well. I say that for 4 different reasons. One is we didn't have any material entries this year. First time in several years, a number of years, we didn't have any. And I always use 10 entries or fewer of an entity of this size as kind of a benchmark, and to not have any for all the transactions that we looked at is really exceptional. In addition, you guys the county prepared the entire ACFR this year from start to finish. That's the first time in quite a few years as well. So we've been slowly migrating in that direction. We went to the point where we were preparing probably half of it. And then now this year, the county prepared the statement of cash flows, the actual schedules, the notes, all the conversion adjustments from start to finish. So that's, not many governments have the capacity or skills to do that.
Somebody needs an applause.
So we also issued our unmodified opinion on it, and that's kind of sometimes taken for granted, but there are so many accounting rules out there. 100 of them apply to the county this year, and there's 4 more coming around the bend. So, there's a lot of things that have to be adhered to. But I think lastly, and I want to say that from our standpoint, probably one of the things that's most important is how well prepared the county was when we showed up on day one. That has continued to be moved forward every year. And this year when we came in, capital assets were ready. I can tell you most of our clients don't have capital assets ready. All the receivables, with the exception of a few minor items, and that involves working with all the decentralized departments, pulling that all together in finance, which is a big effort. We got a great system down. OPEBs, everything was just kind of ready to go, which allows us to bring in the full team and get through the audit within a week and a half without too many open items. So that's why we're here today, not in August. And so if you were to look at all the things that we asked for, it's really extensive. And so the county does a great job with that. So yes, the audit went very well. I'm going to turn it over to Leah and she can talk about some of the numbers.
Okay. So I'm going off of, I believe you have this in your packets. So starting with page 1. So page 1 and 2, we'll talk about the general fund a little bit.
I don't mean to interrupt, but I don't think it is in our packets. I think it's in an email.
It is. Are you talking about you're talking about the financial results?
Yes, yep, this is the first page here.
Yeah, an email from a week or so ago from Carrie, and then it's the third
Tab. Possible to pull it up.
tab over, yeah. Good
Hey,
one.
Kathy, can you send me an invite? Excuse me? Can you send me an invite?
Sorry,
No,
No, you're
that's
good.
all right.
Watch it and
Yeah.
see what we're looking
everybody
at.
wanted to find it.
Yeah, you
Yep.
might get lost if I just start talking about some numbers.
And we want the general public to be able to, observe all this chips,
Absolutely.
or staff in this particular case.
I didn't get it yet. Okay,
Huh?
there we go.
Do you want me to do a little soft shoe while
While they're pulling that up, I will tell you, in 30-some years of doing this, that's the first time I heard an applause, so.
We like.
So that's not for Leah and I, it's for the finance.
It's all about first. We've come a long way, so.
Yeah, for sure.
We're here because we like this stuff.
There we go.
All right. There we go, a little bit bigger. Thank you. All right, so page 1 talks about the general fund, kind of looking at like an actual versus budget. So in actual, the fund balance pretty much stayed stagnant. That's the 45,000 change in fund balance. So stayed pretty much the same. The final amended budget, you approved to spend down that fund balance of the 12.3 million. So that comes out to that 12.3 on the right as a positive variance. So revenues and other financing sources came higher than budget. Some main factors there, the charges for services, more specifically the inmate housing contract with Lake County, that gave you about 4 million more than budgeted. And then that was kind of offset by some other taxes, local use, replacement, personal property, cannabis. Those were kind of a little bit down from budget. So that's where you get that 2.9 positive variance for revenues. Expenditures, a lot less than budget. That's that 9.4. So I noted some big areas in like the general and administrative, mainly that kind of non-departmental, kind of utilities, software costs, kind of the contingency was just kind of down from what was in the final amended budget. So you get the final fund balance at the end of the year. Again, just a little bit more than the previous year, ending at that 61.2. So on the next page, we'll talk about what makes up that 61.2. So we have, if you just want to scroll, there's a graph that kind of shows the numbers of how it gets made up and all of the different components of it. But here's the numbers for it. So your restricted and non-spendable, those are really amounts that 874 and the 3.4 this year in 2024. That's kind of the amounts that you can't really touch. So restricted is typically kind of more external restrictions. That mostly has some sheriff funds in it, and then there's some other department components. Non-spendable, the biggest piece there is advances to other funds. So IMRF of $1 million, I think that's been there for a number of years. And then the increase this year was an additional advance to the Social Security Fund of $1.825 million. So that makes up that 3.4 non-spendable in the current year, and the reason for the increase from last year. Assigned, go ahead.
Not to interrupt, but
Yep,
just
absolutely.
for committee members. So we're going to be talking next week, Thursday, at the budget hearing kickoff. But so what Leah's talking about is because the funds we didn't levy enough money in those funds, we had to do interfund loans to those funds in order to pay taxes and whatever. So that's something we're going to be talking about next week, Thursday, but just wanted to highlight that again.
Thank you. And then that 9.9 assigned, each year there's approval for use of fund balance for the next year, and then some assigned amounts for capital projects. So it kind of varies by year depending on what you review and what you'd like set aside for the following year and for capital projects. So after all of restricted, non-spendable, and assigned have been removed, you get to the unassigned, essentially undesignated available funds there of the just under 47 million. So looking at and comparing that those amounts to the fund balance policy, so the county has a fund balance policy that a unrestricted fund balance. So we're looking at assigned and unassigned. So the 9.9 and the 46.9 up above, combined, that's just under 57 million. That's down below. So the policy is that that balance is equal to 5 months of the next year's budgeted expenditures. You can see there the calculations. There's your unrestricted fund balance. You have the 2025 or next year's operating expenses budgeted. So you have the 6.4 months of reserve. So above the 5 months, GFOA recommends 2 months. So you're well above that as well. A little bit of a decrease from the last couple of years, but still above that fund balance policy.
You were 7.05 last year, 7.5 2 years ago. But that's been intentional to bring that balance down, apply it to the next year's budget.
So why does GFOA only recommend 2 months?
They recommend 2 at a minimum. And
So why though? Because that's not realistic.
it's not. I mean, it's purely, and that's going across all municipalities. Counties generally have a little bit higher. It kind of depends on the funding situation with the state and everything else that plays into it. So it's really has to be unique. And the fact you have a policy is what you really should be looking at. If I'm not mistaken, I think the county worked with GFOA to help develop your policy years ago.
That was before my time.
Yeah, I'm pretty old.
Yeah.
I thought that was really more for agencies that had a reliable funding source that, that you could go back to, so you wouldn't have
That's
to,
right.
right? Wasn't
right.
that part of the reason for allowing
That's
them
right.
to do that?
Yes, and if you're heavily reliant upon property taxes, which is going to be more stable than sales tax or something of that nature, then it's going to be more predictable. So maybe you can get by with a smaller fund balance. Also, the dependency upon, this is very common in counties, of other funds upon the general fund. The transfers are going out and things like that, that can really skew that 2 months as well. And then on the flip side, if you're a municipality like a city or village, and there's TIF districts, that can have a huge impact on it as well. So every place is unique. And so that 2 months at a minimum that GFOA recommends, we throw it out there as kind of a FYI, but by no means saying that that's what McHenry County should be striving for.
It just seems,
It's slim,
Seems low, yeah.
well,
for sure. It's impossible.
it's impossible, but I guess the point is, you know, not to be critical, but, you know, GFOA is supposed to be the standard, right? So why in the hell would a standard send out something that is not even realistic? And if so, they should make a caveat that says that every taxing body is unique and, or whatever they want to say, but.
Yeah. I mean, when GFOA looks at this, you know, if they do contract, I'm pretty sure they did with the county maybe 15, 12 years ago or something like that. But they look at all kinds of things. Litigation, you know, how could that impact your fund balance? Natural disasters, other funding sources that you have no control over. There's so many different ramifications that you got to look at the whole picture. And again, every place is unique. I would say most places that we audit are closer to 30 to 40%. Within that range, but then they also have a policy, anything over that, they assign or commit it to capital purposes, so that it reduces future borrowing. But again, with McHenry, you haven't had that challenge lately. So again, the idea is to come up with a good policy and adhere to it.
Sorry.
Pretty low bar, I guess, to.
Yeah.
Any other questions on the general fund before we move on to the other funds? All right, so.
Yeah, I do have a question.
Absolutely.
Are there any parameters on how much is too much for a governing body to hold?
I don't know any anything official or anything of that nature. I think, you know, that'll vary from entity to entity, for sure.
I feel like,
There's
again,
different
like you mentioned, it
philosophies.
goes back to the policy, what, you know, what feels too much, you know, for the county, and then what, you know, what steps would be taken to kind of lower it, kind of same with the other end, if it's low, what do we need to do to kind of bring it up to kind of that policy range?
I mean, so for example, and this is just wildly out of line, but a governing body had 2 years in reserves. So is there anything like that anywhere?
Not that I'm aware of. I mean, there's nothing statutorily or anything like that. It would just be the citizens, I guess, pushing back on that, on the governing body or committee members. It's just a, you know, I only have one place that I can remember that had an amount that was close to that, but they didn't have a property tax. I mean, they were, and so in times of recession, it would go way down. And so the thought was, well, we need this cushion. But, you know, that was a little bit unique. So I think, again, like Leah said, the idea for, you know, transitions in the governing body and management and everybody else is to establish that policy. And maybe revisit every once in a while to make sure, does this still make sense if it's been out there for a long time?
I could see building a case where if you could build a reserve where you could generate enough interest to drop a levy and have none, that'd be great. So, okay, thanks.
There too, I guess, some strategy is to kind of build that up to plan for some sort of big project or big expense in a future year. That would, again, the amounts fluctuate.
And consistency is important too, especially, you know, if you did issue bonds, which in the county doesn't have any outstanding, but for bond rating and things like that, to have consistency in the rates and everything else too. And stability in your fund balance.
Thank you. Any other questions? Jumping to page 3, these are your 5 other major funds, and then kind of one column for the non-major funds. So it kind of mirrors what the financial statements look like. So each of the major funds have their own column and information to display. One note for this year is that the motor fuel tax fund went from that non-major classification to a major fund. So due to the significant activity within the fund, it kind of jumped up to that major classification, having its own column and section within the financial statements. So starting from the left there, the county mental health fund had an increase. There's that 3.7 million net change in fund balance, really due to the change in the funding source. It was the last property tax distribution during the year, as well as the 5 months of sales tax included in that. So kind of having both of those revenue sources landed the county mental health fund with a $3.7 million increase in fund balance. IMRF had a decrease of the 1.2 million. That's kind of a combination of the decrease in the levy and replacement personal property tax revenue with an increase in expenses. So kind of a couple movements there that caused the 1.2 million decrease in fund balance. The American Rescue Fund, so the related to the ARPA funding, had a net increase of 1.6 million. That was really due to a transfer from the general fund in the current year for prior year interest revenue that had been recorded in the general fund, and it was moved to the American Rescue Fund in the current year, as well as additional interest in the current year. So it was a good year for investment income kind of across all funds. The RTA sales tax fund, that's that 8.3 million increase in fund balance. The revenues stayed fairly consistent and flat. There's just a decrease in expenses in the current year. So making that 8.3. And then again, that motor fuel tax fund, not as much spent in 2024, but again, having a favorable investment income in the current year caused a $4 million positive net change in fund balance. So those are your 5 other major funds. On the very right of the page, you have the non-major. So that's about your other 37 small funds that have all of their other different purposes. So all together had an increase of the 2.8 million. A couple different funds, I would say, that had maybe larger changes that are notable. The county option motor fuel tax fund had an increase in fund balance of 4 million, and then Social Security fund had a decrease in fund balance of 1.2. So again, all the other funds, some had increases, some had decreases, but those were the couple main funds I wanted to mention. When you look at the 38.8 fund balance for your non-major funds, that is it includes a couple different types of funds. If you just want to scroll down a little bit. Gary, there you go. So you have special revenue funds, capital project fund, and then permanent funds. So that was your working cash fund number 1 and number 2. So in the current year, all of those funds were transferred over, I believe, to the general fund to kind of close out those funds. So that's why you see nothing there for permanent funds. I believe the intent is to kind of close that out in the current year. And that's all I had for those. Any questions on your other major funds, non-major funds? So the very last page, page 4, is your proprietary funds. So you have your major enterprise fund, that's Valley High. That had a net decrease in net position, very similar to fund balance, obviously, of just above a $500,000 decrease. So there's the 521,000 decrease in net position. So really, I saw both, revenue and expenses increased from the prior year. I think what helped in this fund this year was, again, investment income. So good year for investment income of 1.5 million, helping to cover some expenses in that fund. Your non-major enterprise fund, the 911 fund, a very similar decrease in net position, the 519,000. So there were some budgeted public safety reimbursements and grants to agencies that kind of had a increase in expenditures, and then there was a slight decrease in revenues. So landed at the 519 decrease in net position. And then the internal service funds, this really just is kind of driven by claims, so it depends on claim activity. In the current year, there's a 451,000 increase. I think last year it was a decrease. Again, it just really depends on claim activity. Swings in these funds are pretty normal. So, any questions on the proprietary funds?
Can you explain to me, so you say, so up there it says Major Enterprise Fund Valley High. And that's the only thing in there is Valley High?
Correct, yep, that is the county's only major enterprise fund is Valley High, yep.
So why does it show that we had 35 million in that fund?
That's the net position or equity at the end. Most of that is in capital.
So do you break that out?
We do on the balance sheet. Okay. See what next one.
Okay.
Another thing to point out about Valley High, it had, as Leah said, that 521,000 loss. Obviously, as a full accrual fund, your depreciation expense for the year was 518,000. So look at that from that perspective. It's, if you pull out the depreciation operation wise, it's essentially broken even.
I'm sorry, it's what?
It's essentially broke even, which is what which it's supposed to be doing.
Right.
I'm just trying to, public sitting out here looking at this, and I don't want the wrong perception to happen.
Oh no, most of that is in capital. If you, we don't have the balance sheet up here, but it's in the financials, obviously. There can be 3 components of equity or net position in an enterprise fund. The net investment of capital assets, which there's no debt, so it's all capital, less depreciation. That makes up the majority of that. The area, if you really want to know, like, where does this thing sit at the end of the year, it's your unrestricted net position. I don't have that number in front of me, but it's much smaller than the 35 million. Much smaller.
Well,
Yeah.
Perception, right? So I don't want wrong perception to happen, so.
That's for sure. And the other thing is to look at the statement of cash flows, see how the cash flow, I'm going from memory here from a couple weeks back, but it might have been negative this year.
Well, Tom makes it pretty close to break even, so that's.
Yeah, right. Some years it's positive, some years it's not.
Well, that's the whole point of the bed mix and what we're trying to do. So I mean, we're not trying to make money on the operation, but we're not trying to support it either, so. Just wanted to make sure you realize you didn't have 35 million sitting there.
Oh, I'm well aware. Then we'd really get an applause.
That's all right.
The other document that we issue is the reporting and insights. I'm not going to walk you through that, but I believe it's on the county website as well. This is a lot of language or communications that we issue for all of our audits, but it talks about things like what are our responsibilities as your auditors, because some readers may not understand that, but we're really gap auditors. We're going against the GASBs and making sure things are materially correct. So it lays that out. There's some required communications in there, about 3 or 4 pages of those that, touches on things like, did we have any disagreements with management? Did they need to bring in any other firms to get a consultation? Was there any fraud noted during the audit? There's about 15 of these different things. There's nothing of concern of that nature in there, but we tell you that in there. It also talks about new GASBs, a couple that are effective this year, as well as some that will be effective for next year. The big one next year is going to be compensated absences. That's GASB 101. So we'll work with the county proactively on that. Our calendar year end clients, which are a lot of them, had to implement last year, so we're definitely ready for this. I don't think it's going to be a major impact on your liability for the vested benefit, for the accrued benefits, but we'll go down that path and figure that out. But the couple pages that most places are interested in are the internal control matters in here. Those for the county are on page 6. We do still have the control item in here regarding financial statement close process. For the last several years, it's been a material weakness because we have prepared sections of your financial statements and we've had some material entries. And I know I said that we didn't have any this year and the accounting completely prepared it. It's no longer a material weakness, which is great because that gets you to be what's considered a low-risk auditee. It affects how many programs we have to audit for the single audit and a couple other things. But we still did have some feedback for some changes. So it's a gray area. It's considered a significant deficiency. I know it sounds almost worse, but it is not under the guidance that we go by the CPA. So that's definitely an improvement going forward. I think some of that was a result of the county switching to a new financial reporting system and some of the challenges with that as well. I think it's a great looking effort, to be honest with you, but I know it was a lot of work to get it to that point. I think going forward, a lot of that's been established in the system for McHenry County, so I think it'll be a lot smoother and the focus won't have to be on how do we get this thing double underlined or how do we get this new column put in and things like that versus focusing more on things that we picked up on during the course of our audit.
It did challenge Leah a little bit.
I heard that. And that's okay because, that's, you should be asked and I'm glad that you took an interest in it. But it's definitely a step forward. And then, perhaps next year there won't be that comment, but we'll kind of see.
Perhaps?
Well, I can't promise it. So overall, and I've said this to this committee year after year, 95%, perhaps more of our reports have that comment in there. Most of them are material weaknesses, just because there are so many accounting rules, so many things that we can discover during the course of the audit entries and such that it's hard to have a completely clean report that's prepared in-house. But you're really, really close to that. So. Any questions on that report? If not, we also do the circuit court audit. We issued that the same day as the county last week. Compliance and financial, and no findings in there, no compliance issues, and we're working on the single audit right now. And that will take place over the next month or so. Under federal water programs.
Does committee members have any other questions? So I'm gonna lob a little bit of a softball out there, and it's a precursor for our meeting next week, Thursday, which is our budget kickoff meeting. But can you, from an auditor standpoint, can you opine on the interfund loan that we're doing in order to support basically 3 funds that we didn't levy enough to continue through the year?
Yeah, that's what we call an advance. I think it was like a loan. And so GAP says you have to have an advance if a fund, one of the funds outside the general fund, has a deficit cash position, because you can't report negative cash in your financial statements. So if IMRF has negative cash at the end of the year, it has to get the money from somewhere. And if it doesn't have the ability to pay it back within a year, is what GAAP says, then it has to be shown as long-term or an advance. Now, those funds do have, I think, both of them, Social Security and IMRF, have had cash at November 30th. So it could be a cash flow timing issue.
Cash flow, but
Sounds
yes.
like it is, because every time we look at it, there's cash in there. And so we ask every year, do you want to keep IMRF with this advance? And the answer's been yes. So because of other lows during the year. So for the audit, for the standpoint of the audit, if it's not negative at the end of the year, and even if it is negative, but it still has the ability to pay it back during the year, and then it would go negative again, you don't have to report that as an advance, which then moves that category out of non-spendable in your general fund and moves it down into the area that you would measure your policy against as unassigned. So from an auditor standpoint, like you asked, you don't even have to report it all. Or you could show it as a due, if it was negative and you say, well, we're gonna be able to pay it back in 3 months, you could show it as a due to, due from, which that doesn't get tied up in non-spendable either.
Yeah, I mean, it's a cash flow issue for us because it's supported through property taxes. And so when we get through to May, roughly, that's our lowest time. And so we don't have the cash there. But come November, after we've had both things, then yeah, there is, but.
So we audit, I would say the majority of our clients have one or more funds with negative cash at the end of the year. And to be honest with you, because of the fund balance accounting system, and that's the whole concept, right? You have different funds, you can track all these activities separately within the system, but they share one cash account. So equity and cash, treasurer's cash, it just gets, the system distributes it. So when we show up a lot of the time, I would say most of the time, our clients have several funds that are negative. So, okay, we can't do this. You gotta get cash from somewhere, so they make an adjustment at the end of the year. Sometimes it's a due to, due from, because they've got a grant coming in, or whatever it is a timing issue, but sometimes it's in advance. McHenry has proactively said, look, we, years ago, at least for IMRF, didn't levy enough, and so we're deficient, so let's just do an advance from the get-go. We'll keep that money there, knowing it eventually has to pay it back. So I think there's a couple ways to handle it. You could just say, look, we're gonna end up being negative every once in a while during the year because, you know, we'll slowly inch that up. In your financials, it wouldn't be presented as non-spendable as long as it was positive at November 30th. You know, it's just one point in time. Or you could just keep that going, and a lot of places will establish a repayment schedule and say, we're gonna bring this down a couple $100,000 a year, whatever, however you wanna approach it. So it's really a county decision. The only thing that's not is how you present it in the financials. If it's negative, it's gotta be at least an interfund, if not an advance.
Did you guys understand all that?
I do.
Okay.
Do you see it as an issue?
Well, it is an issue, yeah, it's an issue which we'll expound upon next Thursday, but, well, they were here, I just wanted them to say something about it, but yeah, it's an issue because we're taking it out of one pocket, general fund, dumping it in another in order to meet in this case, payroll issue. So to me, we should be levying more to compensate for that.
Or bringing down a 6.5 month advance down to a 5 month, reserve to a 5 month.
Well, and that's,
Not increasing a levy by any means.
it's levy, not, it's the individual levy in that, in this case, you know, whatever fund is
I mean,
having.
overall, not increasing the levy. I
No,
mean,
this is, I'm talking
so
about.
So we were probably talking the same language, but you're not talking about increasing the tax burden to taxpayers. You're talking about just rebalancing things.
Yes.
Okay.
Taking the pie and moving a little more piece of the pie to a different fund versus another
A
fund.
little sensitive here, Mike, so
That's okay.
Okay.
Yes.
So you have options for sure.
Right.
You want to treat that.
Okay. Anything else pertaining to our budget discussion next week that you want to opine on?
I don't think so.
Heck no, I want to stay the hell away from that. Okay, we're done. Thank you.
Not much of a budget expert.
All right.
Other than that, thanks for having us, not this morning, but as your auditors, we appreciate working with everybody here at the county. And yeah, I think we get a good system down, and we bring a good team in here too.
Well, thank you for your hard work. Thank you for doing a great job. And next year, no findings is what I'm.
It's always a go.
That's what I'm looking for. So. Okay.
Oh, just real quick follow-up.
Great, thank you.
Unrestricted net position for Valley High is 2154.
Good. Thank you. All right. We're on to routine consent agenda. Are there items that members would like to hold? Anyone? Do you have something,
I
Carol, or
do,
no?
I'm just trying to figure out which one it was. Well, 7.5. And then let me just see real quick. And 7.2, just a quick question on both of those. And that's it.
7.5 and 7.2?
Wrong order, but yes.
Okay. Any others? Okay, then I'll entertain a motion to approve the routine consent agenda minus 7.2 and 7.5. John makes a motion, Terry seconds that motion. Go to vote. John?
Yes.
Eric?
Yes.
Terry?
Yes.
Carolyn?
Yes.
Larry?
Yes.
And myself, yes. Motion carries. Okay, we're on to item 7.2. I'll entertain a motion for item 7.2. Larry does, Carolyn seconds. Carolyn, you pulled this one?
Yeah, just a quick question. What happens when, for this position, once the ARPA interest is no longer there?
Yeah.
So that's just what your plans are going forward?
Yeah, we are going to have discussions kind of this budget cycle with finance and administration, and we have some potential plans on some revenue sources to fund the position, but it's kind of preliminary, so we want to have those internal discussions first before discussing with the board, just so we could firm up those plans. Yeah, so I don't have anything to kind of talk about today, but we've been kind of talking about some potential revenue sources. But right now we have a need, and we have a lot of ARPA work and internal audit demands. All my staff do a combination of ARPA work, but we marked one position for ARPA. And so we have a need, and we struggled to find a candidate that really could fulfill the role comparable to the individual that we had in the role. Unfortunately, they moved out of state, but we have been lucky enough to find a candidate with a master's in forensic examination and 5 to 6 years of internal audit experience, and has able to hit the ground running and really help our department. And so very difficult to find someone of that caliber willing to work only 30 hours versus 37 and a half. So this is kind of why resolution is coming now to the board. But really, internal audit is a consultant here at the county, so they need to have ability to sell recommendations, provide advice, and really be a high-performing employee. And so that's what we believe we have in this position. So it's really investing in the future of McHenry County and kind of that collaboration that we have working with departments. We want that to continue. So they're not just like a numbers pusher. They are someone that can really have strong people skills and have that level of due diligence and kind of forward-looking mindset. So I appreciate. Any other questions?
I don't want to put words in your mouth, but I just want to make sure that I understand what I thought I heard you say, so that this is not just a person who can basically see through the numbers, but that they can look at them and then pull out, communicate and pull
Right.
out from a situation talk to a person, and I'm thinking what we recently went through in the health department, things that might need to come through in a situation which is a little bit more than just looking at numbers.
Correct.
Okay.
So this individual has the ability and already demonstrating the ability to lead internal audits. I still review everything. They can work with some of the other staff in my office to make sure field work is getting done, but conduct internal audit meetings with departments and communicate. Because a lot of what we do, we have to sell our ideas. Departments can be resistant to change, and some of our recommendations are dramatic changes. So being really a change agent for that department. Sometimes they have the ideas, but being that facilitator and that change agent. And this individual is potential to be a future leader here at McHenry County too. So I really try to recruit and bring in kind of the best that we can obtain in the market. And we waited kind of 5 months and interviewed a bunch of candidates, and kind of the only one, most of the candidates all wanted 37.5, but kind of the only one that we considered at the end of going through the complete process. So, yeah, and I do plan on bringing him to a future meeting as well. You'll be seeing him around, so.
Any other
Great
questions?
I'll just add, Shannon talked about, different revenue sources, and I don't know what's on the horizon, but we are working with the mental health board in Shannon's office and finance office to maybe look for some different opportunities for collaboration. Mental health board is now down 2 key staff members. I exchanged some emails again this morning with Connie Machini. She's interested in looking at some of these opportunities, so we'll see where it goes.
Pertaining to the audit function.
Okay.
Yep.
Great.
Thank you.
All right, we'll go to a vote on item 7.2. Eric?
Yes.
Terry?
Yes.
Carolyn?
Yes.
Larry?
Yes.
John?
Yes.
And myself, yes. Motion carries. We're on to item 7.5. I'll entertain a motion. Carolyn and Larry. And Carolyn, you pulled this one?
I did, and just quickly, Terry's here, but when you look at the cost on the resolution, it's, I'm trying to find it now, $321,000. If you look on the actual, it's not the cost proposal, where is it? I'm sorry. There's another 137,000 for professional services. I believe it's a one-time thing, but it's not in the resolution.
So what's the question?
If that needed it doesn't matter because they're just looking for the 321. I was just curious about what happened with the 137,000.
Does anyone know?
Maybe not.
It looks like the first year is 458,000, right? That's where you're going with the difference?
Yeah, well, so they had the costs.
Implementation.
And it may be that they're not going with it was the project total. I guess it's cost proposal. This is what they're bringing forward. I'm fine with that. I was just curious about what happened to the other 137,000, if that's even being brought forward. Maybe it's not.
Maybe they're funding it through some other means? I mean, I don't, my guess is, they have multiple accounts that they can pull from, so.
Yeah. I was just curious because it was in there as part of the whole
Right.
thing. So, but I'm fine with the way
Okay.
for this as it is.
All right. Any other questions? All right, we'll go
Why
to,
won't we find this, excuse me, but why won't we find that out or at least before the board meeting?
hey, Pete, can we get an answer to that?
Yeah.
It looks like it's a savings, but it's not clear.
I think that's the professional setup services in year 1 is the way the proposal
Well,
is reading. But I don't think it's part of this resolution, so it might be handling separately, and that all we're asked to vote on right now.
We're reserved the answer.
Okay.
Laura and I are looking.
Yeah, no, it would just,
Kathy could not be here today. So.
It would only
That's
be in total, it would be 458,000 when you add in the
That's a really
professional.
big question,
So, but that may be handled separately somewhere else.
We already have
Yeah.
some budgeted in
Yeah.
professional services, so I'm thinking this is what's needed new to cover it.
Okay, so this is
the
the
difference, the additional part.
Can we get that clarified before the cow? So,
Sure. Kathy will be back in the office on Monday. She was having a procedure today, so.
Yeah, if she wants to just email the board, just the
Okay.
full board, and
board,
just
okay.
the answer to that, and say, this question came up in finance, and this
Okay.
is the answer to it.
Okay, very
That'd be
good.
great.
Yeah, it might be that it's already been taken care of and the add-on is the AI for the 321,000.
I think that's
Carrie, do you
what-
by chance know,
We'll have her clarify that.
item 7.5, which is the clerk's resolution, the delta between what is being approved and what is being,
What's on the software cost sheet?
I do not know that.
okay.
Okay. That's,
This is.
All right, that'd be
Okay,
great, thank
we'll
you.
do that. Thank
That's
you.
fine, thank you.
Oh, got it.
Okay, we'll go to vote. Terry,
Yes.
Carolyn,
yes,
Larry,
Yes.
John,
Yes.
Eric,
Yes.
and myself, yes, motion carries. All right, we are on to reports. Carrie?
I don't really have like a formal report, unless you guys have questions.
That's fine. I think you did a great job. Let's call
yeah,
it.
great job on the audit.
Yesterday afternoon, Gary and Mike and I kind of worked on the presentation for next Thursday at the committee of the whole meeting. So you're going to get a lot of Carrie next Thursday.
So your head is spinning.
Yes, we've been finishing the audit,
Suzanne?
completing the single audit. That was due, we had it submitted last Friday, and then budget, right into budget. So, yeah, if you guys have questions, of course, I'll always reach out.
Yeah, I challenged Carrie a little bit. She brought forward yesterday a 153 slide deck, and I said, you probably need to cut that down just a tad. But,
He's kidding.
Is he kidding?
she was all excited about it though.
I know.
No, I think it's gonna be really good. It'll be very informative and, you know, it'll help propel us forward as far as not only the budget discussion, but, you know, what things will look like, and hopefully make our budget process easier, so. Yeah, it should be good. Any questions for Carrie? No? All right.
but I will say your demeanor is great because this is stressful, but you never really let that on. And so, great job.
Well, thank you.
Did you see the punching bag thing in her office?
I know. That's why I won the wellness award.
That's right.
Does it say Mike across the bottom?
Yeah, that's what it does.
This is finance and audit.
Oh, I see.
Yeah. EDC, I don't know if there's anything,
I guess.
oh, you got something?
Yeah. I had lunch today with World Business Chicago. We've been in Greater Chicago Economic Partnership, GSEP, anticipating the pitch for next year's membership. It won't be, I'm anticipating some increase. It can't be huge, but I'm anticipating some aspirations. So we'll have a better number to put in the budget. Just for perspective, you know, it was about $31,000, I think, or $30,000 was our membership per year for 23, 24, yeah, 23, 24, 25. So this would be for 26, you know, probably going to be in the $30,000 to $40,000 range again, but we'll see what it is.
The only other thing, we're collecting investment dollars right now, and we're actually ahead of target, which is really good. Mark is doing a great job of going out and talking to both the municipalities and the businesses about the value added that the organization brings. So it's been very well received. We're working on the annual dinner. And we started talking about that
If
and,
you have ideas for speakers, we'd love to have them.
yep, that is correct. I was gonna say that, yes.
Seriously.
Yeah.
I know you are.
Micro, try to get him free.
So we're doing that. And the other thing that the executive committee has been talking a lot about is strategic planning. So we talked with the full board about what that would look like, how we would go about doing that. And I know that that's something we're trying to achieve, probably in the next 2 months here, is setting that up to go over, putting together a strategic plan, which we haven't really, we haven't done a full strategic planning session since Pam Capata was around. And so we're in desperate need of providing direction for Mark and direction for the organization, so. Anything else? No? Anything?
Mark got his contract renewed.
Yep, that's correct, yes. That from McHenry County?
I got none.
Okay, all right,
Scott's in Champaign, so otherwise you say something.
that's all right. Okay, well, with that, then we can adjourn at 9:26 and 22 seconds.
That's awesome.
Is there a motion? Oh, John and Terry, all those in favor say aye.
Aye.
Any opposed? Motion carries. Thank you, everyone.